Here. Intermediate Corporate Finance Lecture 2. Today's lecture will be about valuation basics. Before we start, let me ask you a question. First of all, what's the most important lesson in finance, right? Thinking about what Jim Rogers told us, right? What was it? Number 1 and number 2. Buy low and sell high, that was number 1, and don't invest in what you don't know. Okay, it's going to be important for our today's lecture as well. You're going to see it. And the second question is, which is observable in asset market or stock market? Price of it or true value of it? Okay, which is observable into your eyes, right? That was price. The value is something that you are estimating. Okay, we're coming up with the numbers, but that's not an objective number. Okay, this all that you will learn today is the point of this lecture is that the value estimates will be biased in various ways. Okay, your job is to identify the source of potential biases as a reader of valuation report. So that's something you have to keep in mind. Okay. By the way, as just a fun fact today is that I wanted to show you my what's this, launch pad. Okay, colorful, right? And I purchased this one last year, but I had no time to learn about how to make electric digital music. But I'm going to create a little bit of it and try to practice it and use it for our lecture, not to make you drowsy, so that you can wake up. Okay, so let's hope for the best. Okay, I hope it's going to be an interesting exercise, right? Today I'm not going to use this launchpad, but from next week maybe. Okay, if I can create some sound like bye. Let's see. Anyway, just as an update for the market today, Dow Jones Industrial Average, which is the average stock market performance in the United States, 30 biggest companies in the US, right? Their stock price plunged by about 3.58%, okay? And S&P 500, okay, the biggest 500 corporations in the US stock market, the index plunged by about 3.4 percentage point. And NASDAQ, which is a tech stock index, right? About 4,000 different companies are there, right? Tech companies. Index fell by about 3.1 percentage point, okay? What's the big deal by looking at this number? Well, on average, in any given day, on any given day, I would not be surprised if the market index goes up or down by about 1 percentage point. The standard deviation of this return, daily return, is about 1.5 percentage point. But today, it's more than 2 times, right? More than 2 standard deviation away from the mean. Okay, that's a big surprise, right? Big surprise. Why did it plunge, right? Why did it plunge? Because of the Corona-19 virus. Obviously, there was a news in San Francisco, California, saying that there's a whatever princess, the cruise ship. Okay, now is a time for, the cruise ship named Princess is in trouble. Japan or America commonly. Okay, unfortunately, this cruise ship, they found out a lot of infected passengers of this virus, and then one of them died. So that's why this passenger ship, right? This cruise ship is harbored in San Francisco, and then the California declared a state of emergency. Now, this stock price return index plunging was happening since ever since there was a virus outbreak in Wuhan, China, 2 months ago. And then the interesting thing is the countries, right, involved. Their leaders are overconfident about their ability to block the disease, block the pandemic. By nature, people people select those guys who are vote for the guys who are more overconfident to be in the leadership position. Okay, and the guys in those positions, their overconfidence plays a role over here to my understanding, right? And they say, oh, this disease, it's okay. We're going to be able to control this one pretty soon. Okay, don't worry. Okay, rest assured, we're going to take care of it. But that overconfidence is, how do you say, breeding this kind of disaster even more, right? In this time, especially, this is the case, Corona-19 virus, right? Because of that overconfidence of those the ruling people, right? They take slower measure or weaker measure to block this disease, like stopping those passengers from the countries that originated this disease, right? They should have stopped it as soon as possible, no matter what. Just as it had to be a rational response. But for this kind of overconfidence, or maybe due to the diplomatic concern, right, they were slow in stopping those passengers, right? And during that golden hour, golden time, okay, this virus was extremely spreading out very fast, even spreading without any symptom that you see in a bodily symptom, right? So by the time you find out those people with the symptom, it's too late. It's too late. Country after country, we are experiencing this kind of fall off, okay, of public health issues, right? And this kind of public health issues are directly affecting the stock market index because economic activities gets affected like terrible, right? You see, our globalization or the business relations, all these were built on the premise that we are all healthy, okay? Businessmen, you have to be healthy in the first place, right? Smart people together, right? The same level of smartness of your brain. If you have better health condition, you're more likely to end up in the business. By the way, because you have to carry all those stresses and then all those responsibilities together with you, billions and billions of dollars with you, you need to be healthy. And then the face-to-face contact and meeting with people, shaking hands, right? Talking to each other, right? All this was, basic assumption is that nobody is spreading any disease to each other, right? But this virus is breaking into that, okay? So much so that, nobody wants to go to the restaurants, nobody wants to go to, meet the people, right? Um, uh, so it's basically shutting down all those business activities. So those cash flows will be plunging, and expected cash flows will be really, really terrible this year. And then the risk level will be really, really high this year, which means the index level has to be very, very low. Okay, the true value of any companies, almost any companies, right, have been going down. Now the price reflects that, okay, in real time. So much so that we say the stock market index, like Dow Jones, is a thermometer of the country's economic health, right? You can see it in real time. The interesting thing is, why is it only 3 percentage point down? Okay, if you think about what happened in 2009, the stock market index plunged by about 40% in 3 month horizon. Okay, this time we are experiencing, I think, similar situation. Okay, this is what Professor Rubini in New York University was saying as well. 40% down compared to the peak, right? But the question is, why isn't the index gets reflected 40% minus in one day, in one shot, bam, right? Instead, why do we see 3% or 5%, 6% plunging in one day, and the next day you see a rebounding of price index? Down and then the rebounds, down and then the rebound, down and the rebound, right? Why do we see this kind of rebounding? Well, my part of answer is behavioral, right? Psychology. the people, okay, people are slow to reflect the negative news. First of all, it's hard to incorporate, and then the degree of negativity, right? We don't know how much of an impact this virus will have. It's going to be huge and tremendous, but we don't know whether it is 40% or 50% or 60% or right 90% or something. We don't know. Okay, that's first reason. Number two reason is behavioral. Okay, the first one was more economic. This one is more behavioral explanation. People have confirmation bias, 확증 편향 in Korean terminology, so that and plus they have overconfidence about the future. We all have overconfidence that our chance of survival is bigger than the actual reality. That's why we have hope, right? That's why we are not, avoiding suicide and then avoid the depressions. We have evolved to have more overconfidence in our mind. And plus we have confirmation bias, which says, which goes to, if it goes together with our overconfidence, we would say, no matter what kind of negative news we face it, we will be always like, no, 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 it's all right. It's not that terrible, right? For example, this time when the Wuhan virus first broke out, right? There were some gag message spreading around in social media that says, "Don't worry about this Wuhan virus. It's gonna go away quickly because it's made in China." It's kind of making fun of the cheap Chinese product in the market, right? But that's representative of this overconfidence, right? Again, underestimating the threat. So that kind of thing is going on in the stock market, okay? So watch out, right? And we are going into the uncharted area. Okay, I'm very afraid of it. I mean, the concerned about it. Okay, but let's see. Now, talking about the stock market index, let's go to Korean stock market index ever since 1980, right? Because that was the time when this index is available in Kospi, right? Now, all the index, right? Stock market index is the average of stock price or stock market value, you would more easily said, right? Average of all the 100 biggest companies in Korea. That's Kospi index, right? And we set the reference point 1980 as 100, okay, to be able to compare today's level of market cap or size of the companies, right? How the company has been doing, right? Now the index level, well, had been performing at the 2000 level, which means compared to 1980s, right? Those market size grew up by 20 times or something. And one interesting thing that I want to highlight is that we can split this period into two, which is the period that you guys were before you guys were born, and the period after you guys were born. Okay. If you look at your parents' period, right? Your parents were in college. Those period was relatively stable growth period. Okay. Korean stock market index has been growing up in 1980s, right? We had no worries about the future, right? That's why your parents, when they were in college, they had such a party time and then drinking a lot and then studied nothing and still got a job in Samsung. Okay. In contrast, ever since 1997 East Asian financial crisis, the stock market had been much more volatile, much more risky. We experienced Asia level financial crisis, which was unprecedented before, right? And then 11 years later, 2008 and 9, we had global level financial crisis, Lehman Brothers or Bear Stearns. I mean, when I was in college, in your age, Lehman Brothers was one of the biggest, banks that sounded unlikely, sounded the farthest away from such concept as bankruptcy or whatever. Impossible to imagine this kind of things. Well, some kind of invincible figure was Lehman Brothers and Bear Stearns, but they went bankrupt or busted in 2008 and 9. That was the magnitude of you know um, uh, this crisis. And as I said before, 2009, when this kind of things happened, 40% of market cap in the stock market disappeared. Okay, um, in 3 months horizon. Okay, very quickly. Um, and then we are facing another one 11 years later. Okay, if you look at the U.S. stock market, it's quite similar because the global stock market is very integrated and interconnected. Okay, mutually influencing each other. But primarily, the U.S. market index is influencing Korean stock market much more. Of course, it's biggest size in the whole world, and we are very much dependent on the U.S. economy, um, especially before 2000s. After 2000s, decoupling seemed to have happened because we are much more dependent on Chinese market, and we are experiencing another kind of deep, lost decade ever since East Asian financial crisis. Now, S&P 500 index, that is a stock market index based on largest 500 corporations in the United States listed in the stock market, right? 25 times it has increased. Okay, remember in Korea it is 20 times or something. Okay, but in America it's 25 times or even more because after 2018, last year they had a lot more days of boom in stock market up to the level that people started to suspect, are we experiencing another bubble? Okay, talking about this bubble, right? We have to think about it, right? The financial market is full of the story of bubble and bust, okay, bubble and crash, let's say, right? Uh, in the long run, the stock market, we believe, it is uh, efficient so much so that the bubble goes away and the price reflects your true value in the long run. But if you look at the short run, okay, we constantly see up and down, not just up and down in the short run, in day by day basis, but in monthly or yearly basis, you will see some kind of a bubble pattern and some kind of crash pattern. Um, for example, in 1999 to 2000 in the US NASDAQ market, which is tech stock, if you look at the core stock, right, which is similar to NASDAQ, that was the time when any company pretended to be internet company, okay, by changing their names instead of changing their business structure itself, immediately the stock price surged by about 70% to 200%, right? Why? Because those investors in the stock market were expecting or overly demanding the dot-com companies, right? Dot-coms. These days, we are experiencing another bubble with this AI technology or fourth industrial revolution, okay? Um, the experts in the market, they say machine learning, if anybody uses the word machine learning, that's understandable. That's based on those are typically based on the reality of the technology. But those guys who are claiming AIs, right? Watch out. It's more likely to be scam. Okay. They're overclaiming their capacity, their capability in the technology. Anyway, but people are overly demanding this kind of new technology and new companies, new business structure, without knowing what's going on inside. Okay. Um, but the important thing is, right after this 2000 dot-com bubble, eventually, I mean, this was a time, the bubble means the price deviates from the fundamental true value upwards, okay? Bubble means deviation of price above the true value and to a substantial degree for a prolonged period of time, okay? Of course, how much is prolonged, how much is substantially, it depends on, the situation, okay? But if it deviates from people determine, okay, people believe that it is above the true value level commonly, then it is bubble. And eventually once exposed, which means after the time passes and looking back in history, we can see that, oh, that was a bubble, right? That was a bubble. It's a past tense. You see that? We don't typically say it is a bubble, well, for sure, because the true value is not observable, right? Only in the exposed sense. Looking back in history, we say, oh, we realized that we were riding on the bubble. Why do we know that? Because right after that, we experienced some crash, which means a correction of prices. We say correction. Um, why? Because price is observable, true value is unobservable, and then price plunges back to plunges to a lower level, and it sustains. And later we claim that, oh, the price corrected to true value. Okay, and then crash repeats itself after a bubble. Okay, bubble and crash repeats itself. Right. So 2001, there was a crash in the stock market. The central bankers were afraid of having deep recessions, so what they did was lowering down the interest rate, okay, um, to support the stock market. But unintended consequence was that with the lower interest rate, people could borrow easily, right? Easy money was there. With this easy money, what do? Instead of going into the stock market directly, they started to buy houses in real estate in the United States. Okay, welcome to the real estate bubble world, because Korea or Japan, we have been experiencing real estate bubble for prolonged time. Okay, the United States started to have it in 2005 and 6, right? Plus, in the United States, they started to have this kind of subprime mortgage scheme. That means now the people with lower credit rating, low income, and that the people that could not borrow with a conventional lending scheme, could borrow from now on and invest in the mortgage market. Why? The George Bush, right? The George W. Bush that said, we want people to have homes, right? For everybody. So that's why the real estate market experienced a bubble, because of the over demand for the real estate land and the houses, right? With this real estate market bubble, we had wealth effect. Suddenly you feel like richer than before. So with this wealth effect, what do? Invest in the stock market back again. So stock market index surged back again in 2000 up until 2007. And together with it, there was a complex mortgage securities developed, which is called collateralized loan obligation or collateralized debt obligation, which was repackaging those mortgage contracts, and then what they did was making a portfolio of a loan contract, a mortgage contract, mixing up this subprime low quality lendings with high quality lendings and spreading the risk. Okay, uh, applying those idea of constructing portfolios, right? The basic premise was that the correlated default rate will be very low. Okay, everybody going bankrupt at the same time, impossible, right? So the chance of going bankrupt for these low credit quality guys will be covered by these high credit quality guys. So packaging it all together, they created some securities. We call it securitization, mortgage-backed securities kind of things. That was very popular in the middle of 2000s, right? And then this kind of securitization spurred the bubble even further, and then not only the individual investors but also those investment bankers, right, were jumping into this securitization market, not knowing the risk precisely. Um, again, the Jim Rogers message comes here again. Don't invest in what you don't know, but they invested in what they did not know precisely. So that was what happened in the middle of 2000s, and then after a certain point, right, they realized that, oh, there must be something wrong, and then the what's that subprime borrowers started to go bankrupt with a little bit of higher interest rate, and then people started to realize that these mortgage-backed securities are not perfectly hedging those risks. Okay, and in fact, those correlation of default was much higher than expected, and they realized that all these big banks and then big insurance companies were sitting on this time bomb of this collateralized loan obligation and debt obligation. And that was what happened in 2008, and then they ran for survival, okay, dumping all these securities at the same time, which resulted in a crash in the stock market. That's what we experienced in 2009, as I said before. Now, the central banks in the United States, in Europe, and Asia, this time they realized this crisis, right, was in a global scale, right, because those financial institutions, were deeply connected to each other, buying and selling those CDOs to each other, right? That's why those central bankers were doing some coordinated rescue plan, okay, so that the global economy would not plunge into Great Depression like in 1930s, right? So that's why and plus they, as a way of coordinated rescue plan, those central banks brought some measure called quantitative easing, lowering the interest rate, and then monetary supply, you just increase it, right? So that the business will go on, right? That was happening in 2010s, over the last decade, right? Thanks to those efforts, the United States stock market has been performing extremely good, right? Donald Trump would say the stock market was going up thanks to my ability, but it was, supported by this quantitative easing, um, and up to the level that people started to suspect, aren't we experiencing another kind of bubble, right? And to me, this coronavirus is is a time that we are seeing some corrections or crash back to original level. Okay, and exposed, right? It seems like crisis repeats every 11 years, right? Nobody says that. No economics. There is no economic theory behind it. Okay, but over the last 30 years, right? 33 years maybe. These kind of things may be happening, or but it's not an economic rule, so don't buy this one. Okay, but we find some regularity, empirical regularity, and then even more importantly, bubbles and crash repeats itself. And as you see as an investor, right, the first rule of investing, buy low, sell high, is there. And then you may be tempted to see, oh, if I can buy those stocks in the crash and then sell in the bubble, right? Buy low, sell high. You could do that, right? So you may be tempted to do this kind of investing, right? Here, one picture that I show you is Lemmings picture. Lemmings picture. What is that? Well, in 1950s, there was a famous film in National Geography showing in Pacific Island. Okay, there was a mouse-like feature, mice-like creatures called the lemmings, right? In that island. And interesting thing about it is that they had some herding behavior, running from here and there, only with their groups, right? When their friends run to a certain direction, they run to that direction together. When their friends run to the opposite direction, they all of a sudden they change their directions together, right? So herding behavior was noticed over there, and up to the level that those lemmings were jumping into the cliff, right? Jumping and then swimming in the ocean, right? Running up the hill and then jumping off the cliff and then swimming into the ocean. Some of them dying, right? By the way, this kind of films, right, inspired the stock market investors and then those professors and say, well, aren't we just like lemmings in stock market investment? When your neighbors, right, say that, oh, I made money by investing in real estate market or 대치동 apartment, right? I earned so much money out of it. When you get jealous and they say, what did you say? Okay. And your wife or husband nag on you. Oh, why didn't you invest together with him or her so that you make money like that? Okay. And your natural instinct, right? Basic instinct tells you to go together with him and take a herding behavior. And then the picture over here, okay, we see a group of lemmings, and the ones I want to highlight, the ones that has this kind of life vest over here. Why would they, these lemmings, right, or the investors, go into the stock market bubble together and crash together, right? Each and every one of them may have this kind of things in mind. They must know that's something that I don't, okay? So let's herd together. That may be going on in their mind, okay? But what I want to tell you is that don't invest if you don't know, okay? You make sure you have a life vest, okay? Before you plunge into that ocean together with your colleagues or friends, right? In this kind of situation, right, herding, you can take 3 different strategies. One is to be a proud lemming, which means being a momentum trader. Okay, go with the flow, right? Go with the flow, and then just take it as it is, right? That is one possibility you can do. Okay, trend chaser, right? Trend chaser. Number 2 strategy is being a Yogi Berra lemming, which means you have to be just better than the average, right? But good luck with that, right? If you could buy at the trough of the deepest trough of the crash and then sell at the peak of the bubble, okay? You'll earn so much money. Of course, you would do it. But the trouble is, how do you know today is a trough or the lowest point in the stock market history, stock market history? Only exposed, only when the time passes, then you realize, oh, that was the bottom point. That was the bottom point. Again, so in current or at present, it's always risky and that you don't know, right? Whether this is really the bottom point to buy the stock, or the bottom will be happening in tomorrow or 1 month later. Okay, we never know about that point. Okay, that's a problem with this Yogi Berra lemmings, right? Number 3 strategy is being a lemmings with a life vest, right? Just as I said before. So the whole purpose of doing this valuation exercise is to be more like a lemmings with a life vest and try to estimate the true value of a company in your own way, in an unbiased manner, hopefully, but at least we will have to realize some biases going on, okay? Now, yeah. And then philosophical basis of valuation, okay? Some people say like this: valuation is often not a helpful tool in determining when to sell hyper growth stocks. This was said by Mr. Henry Blodgett, and Merrill Lynch equity research analyst. Nowadays, he's doing podcast kind of things, or in Yahoo Finance, he's doing it. He was saying like this in January 2000 in a report on Internet Capital Group, which was trading at $174 per share, right? Then there have always been investors in financial markets who have argued that market prices are determined by the perceptions and misperceptions of buyers and sellers, and not by anything as cash flows or earnings. Okay, well, perceptions, right? For example, good art. What's that? Artistic work like Picasso's artwork, and then or Modigliani's work, and all these kind of things, right? How do you perceive how much do you perceive the value of this picture, right? The perception itself, right? Depending on the perception, the price may be determined. Okay, but you know, they cannot be all that matters, right? Asset prices cannot be justified by merely using the bigger fool theory. The bigger fool theory works like this. Well, riding onto bubble, right? As long as you can find a bigger fool than you, so that you can sell your asset at a higher price than the price that you purchased before, you are happy to go with it. This is a bigger fool theory. But the thing is, the perceptions have to meet the reality, and then you never know whether you are the biggest fool. Devil takes the hindmost, right? So there is always, this kind of danger lurking around you. The valuation matters, and you have to be able to estimate the true value in your own way instead of believing in the price itself. Okay, price can be deviating from the fundamental values very much, right? So you have to be careful about it. Postscript is that the Internet Capital Group, this company, was trading at $3 per share a year later. Okay, so 174 all the way down to $3. This can happen in your stock market investment, in stock market and Kospi market as well. Big questions for analysts, right? Estimating true value as a human being, okay? Especially given the fourth industrial revolution or those machine learning technologies, right? One question is that Kensho plus Goldman Sachs kind of things. What is Kensho, right? Robo analyst, robo advisors, right? Nowadays, those machine learning techniques are used in valuation as well, so much so that the human beings, human beings, we take about 1 week to generate an analyst report, let's say. Then this Kensho or this kind of robo analyst, it takes about a second or two to generate any report, okay, for a company. Okay, using computational linguistic technologies and then all these kind of pattern recognitions and machine learnings, they can generate an analyst report quite quickly. Okay, is this an Armageddon for analysts at the Wall Street or Yeouido? Yeouido is like a Wall Street of Korea, right? Now, should the analysts be laid off or 100%? Is a question that you have to ask, right? Nowadays, you see a lot of students flooding into double majors in computer science, and then less of students are trying to major in finance, partly because of this kind of robo analyst coming up, right? But in the end, we have to think about whether the robo analysts are complete replacement or substitute of this human analyst, right? Keep this question in your mind. Given that all those values, that true values are not observable, we need to be clear about these misconceptions about the valuation that the general public has, right? The first myth about valuation is that valuation is an objective, unbiased search for true value, all right? The truth is, all valuations are biased, okay? The direction and magnitude of the bias in your valuation is directly proportional to the incentive, who pays you and how much you get paid. Okay. So here's an example, right? In 1980s, there was a big telecommunications M&A deal done by AT&T, taking over a cable company called Linn, L-I-N-N. So typically M&A, you can see me in the picture, all right? Hello, right? So typically I draw M&A deal like this. Pac-Man, right? Here's AT&T. That's American Telephone and Telegraph. The used to be a monopolistic power. You know Bell, right? Graham Bell. It stems from him, right? AT&T, a giant company. Okay. Of course, it was broken down later on, right? But AT&T was there, and then it was taking over a company called Linn, and should I say this, right? L-I-N-N. So this is target company, right? I say target company. This is acquirer company, acquirer. And M&A advisories should be one of your favorite or most aspired career goal in the future, I guess, as long as you're finance guys, right? So those investment bankers were advising, okay? One of them, I don't remember exactly which one was it, but Lehman Brothers, okay, was advising AT&T. And then Linn was advised by Morgan Stanley, right? Morgan Stanley. And then the job of this M&A advisor is to estimate the true value of the target company, Linn Technologies, right? Let me see it. Turn it off, right? You can see it clearer. Okay. So, the thing is, in the due diligence process, this target company has to disclose all this material information fairly to both the advisors of acquirer and the target. So they got the same information about Linn Technologies, and they came up with the fair value, I should say, their true value estimates, okay, in their own ways. One of them came up with about 150? Let me see. Yeah, 155 about this company. And the other came up with 155 per share, by the way. The other came up with 105 per share. Ah, $50 difference, right? Compared to the maximum price, it's like 1/3 of a difference, or half compared to the minimum. How could they be so different? Huh? Are they stupid or something? Any of them? No, they're all Harvard graduates or the smartest guys in this industry, right? So how could they come up with such a different number? That has to do with economic incentives. Who pays them? So which one? Let's say 155. Which one must have been suggesting this value about the target company? Must be Morgan Stanley, because the guys are paid by the target. And the lowest bound must have been coming from Lehman Brothers. Why? Because after all, M&A is about, negotiation and bargaining, okay? For this guys, the target companies, you want to overvalue your companies so that you get maximum cash from these guys, right? On the other hand, the Lehman Brothers, right? The AT&T, right? you want to push down the value as much as possible so that you will be able to negotiate and then buy this company cheaply. Remember, buy low, sell high. That's the principle over here. Okay? So given that there was such a big discrepancy between these two advisors, there came up another guide in the middle. Wasserstein Pirella. I have to sound like more like German. Wasserstein, or whatever. Pirella. They came up with what? Wasserstein Pirella, a third party. They have to, how do you say, please all of them. Don't piss them off, right? None of them. So what did they do? They came up with a nice middle number. Take the average of it. What is that? 127.50. Okay. Of course, it's not exactly the middle number, but they were giving a little bit of a impression about they worked hard, ending up with 50 cents or something. Okay, fine. So this is how things are done in investment banking, right? Why is the case? Because the true value is not observable anyway. And then it's about the negotiation. And for that negotiation purpose, where do you stand? Okay, who pays you? Creates your bias in your own way. So as a consumer or reader of these reports, evaluation reports, you have to be able to understand what's driving the biases, right? And the second myth is that a good valuation provides a precise estimate of value. Why do we have all this kind of myth, right? Precise estimate. It's a natural consequence of having our math education, right, for more than 12 years, I guess, in your life, right? Your mathematical questions, all math questions used to have correct answers. And if you deviate from the correct answer slightly, you're totally wrong, okay? The truth is there are no precise valuations. I told you, true value is not observable. It is just an estimate with an error, right? And this is the point where people are separated. Those accounting guys, right? They are more like a black and white people. Black and white, right and wrong kind of people, okay? If this is wrong, and if there's no true value, oh, those finance guys are liars or mavericks, they say, okay? That's accounting people. Say bye-bye, okay? On the other hand, the other kind of people are finance guys, or more creative ones, right? I think. For these kind of people, the facts that there is no precise estimate of true value free up your mind, okay? Now it's in your liberty, right? The important thing is just to be internally consistent, right? You have to be internally consistent in your logic and building up your stories, okay, in valuing those stocks, right? For example, people often make this mistake in estimating or generating or projecting future cash flows, right? The growth of future cash flow really depends on how much you reinvest. But people oftentimes forget, and then they say we assume a fast growth going into the future, and then high dividend payment, which means low reinvestment. Okay, is it possible? So oftentimes you have to check your internal consistency very well, right? The second point is that the payoff to valuation is greatest when valuation is least precise or the hardest, the most difficult to value precisely. Okay, what am I telling you? Valuing Coca-Cola or some, how do you say, well-established companies, right? ExxonMobil kind of companies, right? Long years of history, U.S. Steel kind of guys, right? Pretty much the business is very simple, and then the valuation will be easily done. Everybody can do it, okay? and then the valuation estimate will be much precise because much more precise than not, because in the first place there is not much of a room for the fluctuation in their business or any changes in their valuation. Especially Coca-Cola or food industry, right? In contrast, if the company has shorter history, like a startup company or FANG kind of, new technology companies, we don't know, okay, what's going to happen in the future. It has lack of history, so that trajectory itself is difficult to predict, okay? So that's why if you are this analyst, right, then by valuing this kind of younger companies and startup companies working for, how do you say, venture capital, right, your payoff as an analyst will be bigger. Okay, that's something we have to think about it. And mature market versus emerging market, of course, if you're working in emerging market as an analyst, your payoff will be bigger. And then if you're valuing in the high volatility period like these days, right, your payoff as the investment analyst will be much bigger. Now, third myth of valuation is about people believe that the more quantitative a model, the better the valuation. Okay, if I project the future cash flow over the next 10 years or 20 years down the road, I can impress my investors or my boss as if I worked very, very, very hard. But remember, work smart, not work hard. Okay, that's something you have to keep in mind. Okay, of course you will be working like hard and smart. There's no work-life balance over here, by the way. But work smart is more important in the end. And that's what this is about, right? 10 years cash flow projection, you don't need it, depending on the industry. If your company is Coca-Cola or McDonald's, right? You have stable cash flow no matter what anyway. So as long as your economic story makes sense, you can carry with just one stage growth model, which means golden growth model like this. Next year's dividend or cash flow divided by R minus G. G means the growth rate of your cash flow into the future, one stage growth rate, okay? And R is the cost of equity, of course, right? Simple model, okay? You don't need 10 years cash flow projection for a simple company like that. Of course, right? Depending on the companies and their life cycle, you may need different ones. Now imagine this situation, okay? You've been working as an analyst and analyzing Samsung Electronics for some reason over the last 1 month, right? Getting all those inputs, like thousands of inputs you have to punch in with your hands like crazy. Of course, part of the job will be done by computer these days. Thank God, that's good. But let's say your model was so much complicated that you had to find out the right numbers and for the right input holes, right? So many of them, so it took you a long time. Now today is Friday night, okay? Forget about your girlfriend or boyfriend. And then it is 9 p.m. in the evening. You're finally punching in the last number of Samsung Electronics and boom, you got the final valuation number. All right, finish writing up the reports and then you're wrapping up and you try to go home and your boss comes in. And guess what he says? You know what, Andy? Here's the 3 years of 3 years of accounting report for CJENM. I want you to value CJENM until tomorrow morning because I am supposed to have a golf meeting with the guy in tomorrow afternoon, right? The guy from the CJENM, the CFO, for example. Now what? Now what? There is an option, okay? One is an option called option to abandon, and saying, raising your middle finger to your boss, I'm not gonna work for you, and then saying bye-bye to the whole industry, okay? The other option is just work, okay? I'm sure all of you will do option 2, right? Given that you're finance guys. So dead or alive, you have to do it. But at that moment, right, think about how many hours you spent for Samsung Electronics because your model was complicated and then you had to punch in a lot of different things. Would you do the same thing for CJENM? Realistically, that's impossible. Okay? In that sense, if you have this kind of simpler model, okay, fine, ding, you can do it, right? Quickly, if you can finish it, and then make your boss happy, that's much better, right? At least let him have some sense of the business. That's it. Instead of giving him the very, 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 very true value, exact value. Okay? What it depends is just a rough estimate of where the CJENM is heading it, right? So that's it. Okay. Yeah. Number 2 is that as you get employed by the investment banks, you will see a lot of Excel spreadsheet model designed and built by the house. House means the bank itself, right? In-house model of Excel spreadsheet tells me to input this and that and that and that. So I just follow like a slave, this and that and that and that, or robot, right? Don't do it, because the in-house model, you never know what the heck was going on when the designer was building up that financial models, right? So design your own way and then work with it. As long as you can tell what the heck is going on with the model, you're fine. Usually that model should be your own one, okay? Because you built it and you know what is going on. But others built it, you don't know what the heck. So that's a problem, okay? Don't do projection for longer periods unless you absolutely have to. The truth is, one's understanding of valuation model is inversely proportional to the number of inputs required for the model. And the truth is, simple valuation models do much better than complex models, right? Getting back to our question about Robo Advisor, the Kensho kind of things, or deep search kind of companies in Korea, right? Now, is this an Armageddon for human analysts, okay, or the analyst in Yoido or Wall Street, right? Should we give up finance because the robots will take care of everything? Well, let's think about it more seriously, okay? What does this robo analyst or robo advisor companies do, right? If what they do is just to collect all those analyst reports, okay, which is supposed to be biased anyway, and then take the average of language tones of the biased analysts, and then those biases are the bias is into the certain direction, like buy sides, buy direction instead of sell direction, okay? Then you will have a biased average, right? Which means garbage in, garbage out, right? The thing is, right now in Korea, there is no sell report. Like only 1% or less than 5% of the analyst reports are sell reports. Why? Because those sell side analysts don't want to piss off those companies they are analyzing. They have to meet the CFOs and the CEOs. They don't want to piss them off. So always say flatteringly, yeah, buy, yeah, or hold if things are good, but not good, right? Now, so given that, right, garbage in, garbage out will come out, right? So as an analyst, right, of course you may be creating another garbage, but you want to be staying away from those biases of the others, okay, to estimate the fair value yourself, right? So it's not necessarily the end of the equity analyst world, I guess. It's just helping you somehow, and then it's getting you to a next level. And so having said that, let's move on to some quick tests of your concepts. 1, you're valuing your own business for sale to a third person. Would you be biased, high or low, or uncertain? The answer is High, of course, it's you want to, brag yourself, and then, if you want to sell it to other people, they have to pay me like billions and billions of dollars, right? So you'll be biased high. You're a venture capitalist valuing this business for an investment, okay, for the same company. Would you be biased high or low or uncertain? Now you are on the other side of the table in the bargaining. So you'll have to be biased low, right? You have to cut down the value price and then just negotiate from there. Now, 3, you are valuing your own business for divorce court. Oh my God. Half of your estimated value will go to your spouse, soon to be ex-spouse. So in that case, would you be biased high or low or uncertain? Oh my God. Okay, so in that case, yeah, of course, you'll be low. You'll be realistic about it, right? You are an appraiser for the owner, valuing a business for tax purposes. So your owner is supposed to meet the IRS or tax agent of the government, right? Would you be biased upward or downward? Okay, high or low or uncertain? Who says high? Who says high? Low, man. Okay, you have to be. You get paid by this business CEO who wants to minimize their tax burden. Okay, for that purpose, you have to lower down your valuation number somehow, as much as possible, I guess. And then question number 5, you are an appraiser for the IRS. Okay, valuing the business for tax purposes. Would you be biased, high, low, or uncertain? Okay, IRS means 국세청, right? 세무조사 한번 해보시겠습니까? It's like a the purpose of this IRS or 국세청, right, is to maximize the tax revenues for the country. Okay, for the country. So for this, would you be biased, high or low, in valuing the target business? High, of course, right? So that's why there's always a disagreement in the tax court, I guess. A lot of litigation, lawsuits going on between the tax, IRS, kind of 국세청, and the CEOs or the businesses, right? You should pay more tax. And they say, I paid enough of tax. And they keep on fighting, right? That's where the lawyers make tons of money, actually. So many of you actually want to become a corporate lawyers, right? That's why you major in, business or global business, and then master those concepts in finance, and then later on you will be fighting for either side of this court battles, right? Good luck, right? Number 6, you are a sell-side equity research analyst valuing a company with the intent of putting a buy or sell recommendation on it. Okay. Now, before we move on further, what do you mean by sell-side equity research analyst? And then what does buy-side equity research analyst means? Let me put it clearly here. Because the previously recorded video, I did not maximize the screen so that you could not see the picture clearly. Now, okay, in investment world, right? Equity investment world, right? We need a fund manager. Fund manager. Hello, right? Fund manager or portfolio manager, we call him or call her portfolio management. She's got a lot of money, not her own, but somebody else's, right? Portfolio, asset management. So this is the asset. Now, she, with this money, she has to buy some stocks to keep her portfolio somehow. Okay? to manage your portfolio. So you have to buy some stocks. So that's why we call any analyst, let's say over here, analyst, okay, working for her, we call him a buy-side analyst. Okay, his job is to look at other all different companies, or this looks like house. Let's put it this way. All different companies, right? And factories, okay, and companies, right there, right? What he does is analyze these companies and report to her internally, in-house. They're in the same house, right? Okay, internally report to her. But for this purpose, he also needs some expert report about the same companies. Okay, there are those analysts. Okay, analyst who is called a sell side analyst, who doesn't belong to any portfolio, any asset, no fund. Okay, they're independent, rather independent, or they belong to a certain brokerage houses, okay, or M&A house, or all kinds of investment banking house. Okay, but they don't belong to a fund. Okay, their job is to analyze. 밥만 먹으면 all they do is just look at these companies and study this industry, and then generate or write a report about buy, sell, hold about these companies. Okay, they're writing those reports. The purpose is to let how do you say, sell this pitch, sell this idea to these fund managers and the buy-side analyst. Okay, buy-side analyst. So sell-side analyst and buy-side analyst, sometimes they meet and talk about the industry together. And for that, with that, this guy learn about the industry further. Okay, but his or her primary job is to serve this portfolio manager. Okay, whereas this ones, they're serving not only fund managers but also high net worth people, high net worth individuals, Warren Buffett kind of rich guys, right? They want to study all these industries, but they want some expert opinion from these guys. They are sell-side analysts. Okay, buy-side analysts, they belong to, I mean, the portfolio managers is usually the ultimate career goal of these people over here. Okay, ultimate buy-side. For example, who is that? What's that? KIC, Korea Investment Corporation, 한국투자공사, ultimate cap, we say it, ultimate buy side. National Pension Services, right? 국민연금, right? They are the ones over here, buy side. And if you are outside of those funds and then working for Samsung Securities or Goldman Sachs, and then every now and then you meet these guys and say, oh yeah, now SK Hynix seems like a good stuff to buy because semiconductor industry hit just the bottom and then it's bouncing back. Right now, buy it. Then you're doing the sell side analyst job. Okay, so that's basically the distinction between buy side and sell side. Number 6. Okay. You're a sell-side equity research analyst valuing a company with the intent of putting a buy recommendation. Would you be biased high or low? Right? Who is paying them? Right? Who is paying them? You have to think about it, right? As opposed to buy-side analysts, they don't get paid by the fund managers. Okay? They have to be, I mean, for them, they get paid by the brokerage house they belong to, and then what's the mechanism that drives them to work and then survive in their career? Well, information source is important for them. Now, for example, let's say you are analyzing Hyundai Motor, okay? What's the most important thing? Your information source in Hyundai Motors, which is 정의선 회장님 or his subordinates, like CFO over there, okay? You don't want to piss them off, right? So will you be able to say anything negative to them, about them? No, perhaps not, right? Career limiting decision, right? So you always want to please them somehow and then say bye, 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 or strong bye, okay? So you will be biased upwards as a sell-side equity research analyst, usually, especially when you are writing buy recommendation. Of course, when you're writing sell recommendations, there must be some other reason driving it. And then there must be a lot of negative information enough, so much so that you are just dumping that stuff, okay? And then once you write a sell recommendation, you will never get back to those people, okay? So you have to expect that kind of things anyway, okay? You have to be very courageous to do that, right? And then number 7, okay, number 7, you are an M&A analyst working for the investment banker, for the acquirer in a friendly takeover. Valuing what? Valuing the target company, okay, valuing the target company. Well, what kind of situation would that be? Is it quite frequent in Korea or emerging market, right? And the answer is yes, actually, okay? The answer is yes. We don't have that many hostile takeovers, but a lot of friendly takeovers going on. Okay? Is it because Korea is more conformative society, or is it because like any culture related to it, so much so that we don't have that much hostile takeover? Maybe. Confucianist society, maybe. I don't say yes. But there's another reason going on there, right? A lot of transfer of wealth from father to sons or their descendants, right? Go through this kind of friendly takeovers, I should say, okay? So what do you mean? Well, for example, you like some cookies, right? Cookies? In Korea, right, if you go to any grocery stores, right, you see a lot of cookies, but one of them is called the Yeonyanggeng, right? That used to be a small company, okay, and then it was taken over by the CEO's father. It's a company, okay. So what could be done, okay? Well, here's father company, and then there's a son company, right? Son company. Well, how can things be done? So when father tries to pay son, would he want to pay more or less? Okay? Maybe you don't know the situation because you don't have kids right now. You're all undergraduate students. But once you get married and then face the reality of family life, right? Things will get more realistic over there, right? So to father's eyes, this business is so valuable, right? And it's so much so that he wants to transfer all of his wealth to his son and then pay the shareholders over here very well, right? So if you're working for father as an investment banker, right? How would you value this company, target company, right? Oh, this company is very precious. And then you will be very biased high in that sense. So that the shareholders over there in the acquiring company will say, yes, vote for this M&A deal, right? Because compared to true value of this, what we are paying is not that much, okay? That's good, let's go, right? So in number 7, you will be biased high, right? And then number 8, okay? You are an M&A analyst working for the investment banker of the target in a friendly takeover valuing the target company, okay? Would you be biased high, low, or uncertain, okay? Your job, okay, is to get deals done. Your job is to get yes in a shareholders voting. Okay, so once you receive a deal bid from the from the acquirer company, okay, acquirer company, your job is to convince the shareholders of the target company and make them believe, right? Influence them to believe that, oh, the offer price is so generous. Let's say, yes, go. So for that purpose, when you're valuing this target company and then saying to the target shareholders, would you be biased high or low compared to the offer price? Low, right? So that's the part, interesting part, okay, going on. So that's your job, right? Again, it's not being a police over there, okay? 금감원 or financial supervisory, okay, or financial police will get to this kind of issues later on, right? And then figure out what was the bias, and then weren't they paying too much, okay? That kind of things. Did they pay enough of taxes there? They're going to go through. But that's that situation, separate situation. If you're working for the acquirer or the target, your bias will be dependent on who is paying you and then what is your job. Okay, so that's something I have to clarify. Now, the number 9 question. Number 9. Okay, you are an M&A analyst working for the investment banker for the acquirer in a hostile takeover. Okay, valuing the target company. Valuing the target company. Right? Hostile takeover doesn't happen that frequently in Korea. Okay, but it is quite oftentimes it is held. Okay, happens in the United States, and then so let's see. Well, when you are in question number 10, if we go first, right? You're an M&A analyst working for the investment banker for the target company in a hostile takeover, valuing the target company. Okay, yeah, your job is to convince to the shareholders that the offer price they are suggesting is too low. Okay, so let them bid up, bid up, bid up. Okay, we are not happy with that number. Oh, get out of our ways, right? We're going to push on with our own management unless you pay us higher. So your bias will be high, as in any M&A setting, except for the friendly takeovers, right? Or father and son takeovers, right? Number nine, right? Number 9, you are working for the acquirer in a hostile takeover. Okay, would you be biased upward or downward in valuing the target company? Okay, valuing the target company. Well, it depends on who you talk to. Okay, who you are talking to. When you are talking to the shareholders of the target company, and convince them and say, lower, we are giving you enough of money, right? So you should be happy to our offer price, okay? We are giving you generous amount of money because your true value is miserable, okay? Miserable. So in that sense, okay, there you will be biased low. That's answer to 9B, okay, an answer to 9B when you're talking to the shareholders of the target company, okay. You say, oh, your company sucks right now. We are paying you so much, so you should be thankful to our offer price. Okay. 9A, okay, is another situation. Okay. When you are talking to the shareholders of the acquiring company, okay, acquiring company, would you be biased high or low? Okay. And then valuing, especially valuing this target company, right? Would you be biased high or low? Given that there is a, what's that, offer price set over there, right? How would you talk to the shareholders if this acquiring company say, you know what? This company is very, very, so highly valued once you take over, right? But the offer price is very low. So we are being very economical, okay? This deal makes sense. So please vote yes, okay? So that's going to be your argument, right? So in that sense, for that purpose, your valuation result, right? Valuation will be biased high. Make sense? So that's an interesting distinction that we have to make. Okay. So that's that. Now, number 11, you're a buy-side analyst valuing a company. Your portfolio manager who already happens to own 1,000,000 shares of its stock. Okay. Would you be biased high or low or uncertain? Now, who is paying you? Okay, who is your boss? Is a question. Who is your boss? Buy-side analyst, as I said before, your boss is the fund manager. Okay, so you want to please him or please her, right? So most often, more often than not, you will be biased towards his decision he already made or she already made. Okay, given that he already purchased, you would say what? Oh yeah, that stock is valuable. I was going to say that, You did a great job, boss. Right? So you'll be biased high. On the other hand, you're a buy-side analyst valuing a company for your portfolio manager who already happens to have shorted 1,000,000 shares of its stock. So given that your boss have sold or shorted that stock, right? Your valuation would be biased, high or low? Low, okay? You sold the stock. Oh yeah, I know, I was going to say the same thing, right? So buy-side analyst report will be biased, okay, a lot towards the portfolio manager's position already. So this is the reason why, the accuracy or this kind of rigorousness is compromised a lot when we read the buy-side analyst report. Of course, as an outsider of the fund, we will almost never have a chance to read those buy-side analyst report. Only portfolio managers will read it. Okay, so the warning would be more relevant to the portfolio managers, right? If you become a fund manager later on, you should be careful about what your subordinates are writing for you. Okay, unbiased those things. Okay, that's the message about here. And some of you may wonder, buy-side analyst versus sell-side analyst, which one is smarter? And then some of them say, well, sell-side analysts seem to be smarter because they don't get paid and they had to get paid by the fund managers, and then they are on their own somehow. Okay. Some independent outside sell-side researchers, right? Aren't they smarter? Well, I would say they are less biased towards fund managers, right? So does that necessarily mean that one of them is smarter than the others? We don't know. Okay. The typical career aspiration actually works like you want to start as a sell-side analyst first and then get scouted by those big funds, right? And work as a buy-side analyst, and then become a portfolio manager in the future, right? Um, so if you say buy-side analysts are stupid, I mean not stupid, but not as competent as sell-side equity research analyst, that doesn't make sense because buy-side analyst, that position is the career goal of intermediate career goal of sell-side analyst, right? So how could they be less competent, right? Um, that doesn't make sense. They're more biased, I would say. So and then also this does not mean that sell side analysts are never biased at all. They are very, very biased. I told you before, about 90% of their reports, of sell side reports, are buy recommendations, right? Especially in Korea. You never see a sell recommendation coming from sell side analysts, right? So those biases are always there, okay? And some of you, especially non-finance guys, right? You may say, what is going on? Okay, this is so disappointing. Every research reports are biased. Okay, what is this finance is about? Okay, give me some correct answer. But this is, this is our life. Okay, and then value. All this is happening. Right. The key message is the true value is not observable. So that's why we have to consider all kinds of biases when we talk about, when we discuss all these things. Nowadays, because of social media, you guys are quite familiar with the biased news media, right? And then sometimes there are some fake news, even fake news, okay? But not even fake news, but legitimate news can be described in certain biased ways. Left wing versus right wing, okay? Always those political stance makes us, very confused, right? In finance, in financial market reports, similar things happen, but in different influencer, right? The factors that is driving this bias is economic factor. Who is paying, right? The incentive is important. So that's that. Said about these valuation biases. Every valuation will be biased, right? Now it's time to talk about three categories of valuation finally, right? One is discounted cash flow valuation, two is relative valuation, and three is contingent claim valuation. Three different approaches, largely, right? We're going to focus much more on discounted cash flow valuation this semester, by the way. And if you are more interested in valuation, go ahead and take a more advanced class where you will learn about relative valuation and other valuation methods, especially the ones taught by Terence Lim, right? 임태섭 교수님. He used to be Goldman Sachs, how do you say, Korean branch CEO. So go ahead and learn from him. This is a terrific guy. He's really, really wonderful class. And tough class as well, but you're going to learn so much. And discounted cash flow valuation, by the way, it relates the value of an asset to the present value of expected future cash flows on that asset. This is basically what you learn in your Finance 101. Those capital budgeting, and then when you were projecting the cash flows and discounted at the relevant cost of capital, that's what I'm talking about, this DCF. Relative valuation is another way of doing it. Well, what is that about? Well, this one, okay, when you're valuing fair value of apartment unit, let's say 대치동 whatever apartment, right? How would you value it? Okay, what's the fair value of 대치동 apartment 35평짜리, right? Or 80 square meters apartment unit. You don't go there and say, oh, the cash flow that we can generate from the toilet bowl is like $2,000 per year, and then the cash flow that you can generate from the windows over there is like $1,000 per year, and then discount all those things at the cost of capital, the value of the apartment would be somewhat. You're crazy. Okay, your boss will kick you out. Okay, when you're valuing apartments, what do? Just look at the neighboring apartment unit with a similar size, and your price, your apartment price, will be exactly the same as your neighboring apartment's value, right? So that's relative valuation. Okay, quick and easy, right? 35평 아파트 is like 25억, and then your apartment would be 25억 as well. Okay, good luck. Anyway, the thing is, this is quick and easy way of estimating value. Just look at the neighboring company in a standardized way. For example, PE ratio kind of things. We're going to talk about it later on. Okay. Contingent claim valuation, it uses option pricing models. There are some, this is once you learn about call option and put option kind of things, apply these concepts in corporate finance setting. Anything that looks like call option, and then you may be able to apply this technology over there. So basis for all valuation approaches. In an efficient market, the market price is the best estimate of value, best guess for value. Okay. I'm not saying that this price equals value all the time, but it is best guess of the market investors today. The purpose of any valuation model is then to justification of this value. The use of valuation model in investment decisions, i.e. the decision on which assets are undervalued or which are overvalued, are based upon a perception that the markets are inefficient, and it makes mistakes in assessing values, right? An assumption about how and when these inefficiencies will get corrected is needed over there. Discounted cash flow valuation, or DCF, right? What is this about? In discounted cash flow valuation, the value of an asset is the present value of the expected cash flows generated by the asset. I'm going to ask you in this in the exam setting as well. What's the two channels of value, DCF valuation or whatever valuation, right? Two channels of value, okay? Two channel, what I mean is the flowing things or the things that affect your valuation number, or the factors, I would say, okay? Two important elements of value. One is cash flow and the other is discount rate. And DCF works with these two, right? Precisely and scientifically. The philosophical basis is that every asset has an intrinsic value that can be estimated based upon its characteristic in terms of cash flows and growth of this cash flow and the risk of this cash flow. Information required is, of course, cash flow and risk, or discount rate, okay? So another thing that I listed over here is the life of the asset or life of the cash flow, right? The mathematical formula is something familiar to you, right? Of course, right? Market inefficiency is assumed over there, right? Markets are assumed to make mistakes in pricing assets across time, okay? And they are assumed to be corrected, okay, over time as new information comes out about the asset. In the long run, market is efficient, but in the short run, market is inefficient. That's the basic philosophy of DCF valuation, okay? If you ask Warren Buffett, he will say the same thing, okay? Market is inefficient in the short run. There's bubble and crash. Price deviates from the fundamentals. That's why we take the opportunity and make money, okay? Basic DCF framework looks like this, okay? This is ABN AMRO's valuation using DCF. I'm not going to ask you, go into detail for every element today, but the whole semester will be about this kind of DCF valuation. in each and every component of it. First element will be your cost of equity, or the discount rate, because here we are using equity side of valuation. So what's the stock price? And then equity cash flow, we will work on it. And then for that purpose, we need equity cost of capital, cost of equity. And then the second element is the cash flow, the dividend, right? Dividend discount model, right? The third is the expected growth rate of this dividend in the future. And the fourth is in the infinite horizon, in the long run, what is the expected growth rate? And then the fifth is calculate or estimate the terminal value. And then sixth, finally, you come up with the value estimate of equity per share. Now, advantages of DCF valuation. Well, economic theory is behind it, right? Discount your expected future cash flow. So it is very solid. It goes back to the fundamentals. And it makes you think about the economic fundamental and then the industry nature itself very thoroughly, okay? It makes you less affected by the market sentiment, market mood, or perceptions, less likely to be affected by the bubbles and bust. And this is why Warren Buffett kind of guys claim that the market is bubble right now. Why? Because compared to my valuation estimate, that price is crazy. Okay? DCF enables you to do this kind of things, right? As long as you are skilled, like Warren Buffett. Okay? If good as investors buy business rather than stocks, discounted cash flow valuation is the right way to think about what you are getting when you buy an asset, right? Warren Buffett typically say like this: I don't buy stocks, I buy that business. I buy into that business. Sometimes he can kick out the CEOs and seriously manage the company, right? For that purpose, DCF is a way to go. Now, DCF valuation forces you to think about the underlying characteristic of the firm, understand the business. If nothing else, it brings you face to face with the assumption that you are making when you pay given price for the asset. Disadvantage is also there in DCF valuation. Since it is an attempt to estimate intrinsic value, it requires far more inputs than information than other valuation approaches, relative valuation or something, okay? These inputs and information are not only noisy, but it can be manipulated by savvy analysts to provide the conclusion he or she intends. So the bias can still be there by the choice of inputs, okay? In an intrinsic valuation models, there is no guarantee that anything will emerge as under or overvalued. Thus, it is possible in a DCF valuation model to find every stock in the market to be overvalued. And then this can be a problem for equity research analysts whose job is to follow sectors and make recommendations on the most under or overvalued stocks in that sector. And then it can be problematic if it is equity portfolio managers. My dog is barking, so 1 minute left. For fund managers, right, who have to be fully invested in equities, DCF valuation may be problematic because when all those stocks in the bubble in the stock market, the conclusion from the DCF valuation will be sell all those stocks and have cash, 100% cash in your pocket. But fund managers cannot do that. They have to have some stocks in their fund. 100% cash, no way. So for that purpose, DCF will be useless. When DCF valuation works best, this approach is designed for use of assets that derive their value from their capacity to generate cash flows. In the future, it does make your job easier if the company has a long history, and that can be used in estimating future cash flow. You have big data of past history, then DCF is the way to go. It works best for investors who either have a long time horizon like Warren Buffett, investing in one company 8 years down the road, 10 years down the road. Okay, they can hold on to it to realize the fair value, right? In the market, allowing the market time to correct its valuation mistakes and the price to revert to true value. Or the investors who are capable of providing catalyst, which means you can kick out the current CEO who is sucking, and then place your friend or as your CEO, and then work out the strategy that you have in your mind. Okay, that's what these guys do, Carl Icahn kind of guys. So that's what the DCF valuation is about. And next week, we're going to talk about relative valuation briefly and then move down to the risk-free rate. Okay, thank you for watching and see you next week. Bye bye.